All right, good evening and welcome everybody for another webinar. This time is going to be Technical Analysis Part 3. We're going to be discussing indicators. Before we start, can somebody please confirm to me that the sound is good? Everybody can hear me okay? Got a little bit of a chat already, but should be good. Yes, perfect, good. All right, perfect, thank you. All right, now, so first of all, as usual, risk disclaimer. I'm going to give everybody a minute to read that. I'm not going to read it out because even it bores me, but you know. I think that's good enough. Right, so what are we going to discuss today? Well, I'll quickly introduce myself to the ones that haven't joined us before. I'm going to quickly touch on what exactly indicators are, how they work, and what different types we have. And then we're going to discuss, in this case, 5 different ones specifically. We're going to discuss moving averages. We're going to discuss the MACD. We're going to talk about relative strength index. We're going to talk about stochastic, and we're going to talk about Bollinger Bands. Now, at the end of the whole story, obviously, we're going to have a Q&A as is custom, and then we'll just go from there. So first of all, about me. So my name is Mike Rotink. I'm 35. I live in Greece. I studied international business studies through the BTEC system of Cambridge in the Netherlands. During this period, I did a lot of international trade for my studies, and I kind of rolled into trading as a hobby at first, like probably most of you. And well, at first I had the same problems as everybody else, made my mistakes, lost my accounts, lost a bit of money. Eventually I had like this light bulb moment where I started to figure something out, it started working for me. Which brought me to what do I do? Well, I started my career as a trader for various retail traders where I was just making signals, more for internal use, just to have like an idea, discussion topic. I never traded assets under management for anybody, so I will never refer to myself as a professional trader. A, don't have the license for it. B, never did people's money. I rather teach people what worked for me, then they can apply that to themselves. I don't believe in copy trading or having anybody tell you how to do it. Everybody's style is different. So yeah, that's the mentoring part, obviously. Since then, clearly I'm now doing webinars as well. This is part of my personal mission to try and spread as much information and provide as many people the chance to have a profitable trading account and know what to look out for and try to avoid, the mistakes that most of us make at the start. In this period, I've also deviated now to going more towards the financial services sector. I'm working on my CISI, which is a license for wealth manager. So I can provide an overall look, apart from just investments. I can also look at other aspects of financial planning for people. And that's me in a nutshell. So talking about indicators. So what are indicators? Well, first of all, indicators are support tools. And what I mean by that is a lot of people ask me, what indicators do you trade with? And I don't like the way that sentence is formulated. And the reason why I say that is that people should not trade based on what an indicator says. An indicator should be the supporting tool to confirm your analysis and thus confirm your trading choice. It should never be the primary reason for you to accept a trade. I hope that makes sense. Right? So there's different types of traders. We have trends or trend defining, which is usually overlay type of indicators. We have oscillators. Now there's part volume, and you will see that as separate. And then there's a small category, and those that have MT5 will have noticed this. There's a section that says Bill Williams. There's a reason that one is separate. I'll touch on that a little bit. Generally speaking, you don't really use it much because they are extremely situational. They're not very consistent. There are certain situations where they are perfect. They work very well in periods where there is a very stable market. But when you get a more fluctuant market, they tend to fall apart. This is kind of why it's a separate thing. The general ones we're going to be looking at today is a few oscillators and 2 overlays. These are the most commonly used ones, the ones that we use. It's the most ones that I use. Volume I never really use that much because in general speaking, it doesn't really matter much what the market is doing volume-wise. It helps you with oversold and overbought, but it gives you more an indication of how volatile can something get. And that puts me to picking your information, right? Too often do I come across somebody that tell me, okay, I need your help. I have my charts. I've been trading in XYZ way. This is my strategy. I trade between, sunrise in the east and sundown, and I only trade if the moon is aligned with Venus. And look at all my indicators. And then they sent me a chart where you can literally no longer see the actual chart. All you see is lines and indicators and 150 technical analysis on top of it and color codes. And like a biggest mistake is what people make is they overcomplicate things. There are a few that work very well together because they all do a similar thing, slightly different. So they complement each other by filling in the gaps. But if you put everything on top of each other, what are you trying to see at that point? Like now you have just an information overflow. You can't see what you're doing anymore. At the end of the day, you still need to make a decision based on what the chart does and not what indicators tell you to do, right? Goes back to indicators are supporting tools. They're not defining tools. This is why I call them support tools. They should support your decision making, not cloud them or make them for you. Now, I hope that makes sense. So having that said, let's start looking at a few. And every single indicator that we're going to discuss today, I'm going to go into a chart, set it up so you have an idea. And I'm going to set it up in different ways with different time frames. I'm going to explain how they work. I know that's going to be a question from you guys. So first of all, the moving averages. I think the MA is probably the most commonly used one. Now, what type of indicator is it? Well, it's an overlay, right? We put it on top of our chart. It doesn't go underneath, which is what an oscillator is. It's an overlay. It goes on top. So what exactly are we trying to do? What is its purpose? So the moving average comes in 2 varieties. You have an SMA or an EMA. SMA stands for simple moving averages, right? It's a smooth linear equation. So if you want to make it in a very correct sentence, it's an arithmetic mean. That's a simple moving average, right? It's a little bit smoother. It's a little bit less prone to false signals, but it moves less fast. An EMA is an exponential moving average, which means it has a weighted average. Right? It factors several equations in and makes an exponential equation out of it, which means that it's slightly more reactive, but it can also overreact, thus giving you more often a false signal. So this is, again, part of the support tool thing, right? Any single one indicator is never going to be enough because they also generate false signals. And it's knowing when it's right and when it's wrong that, makes the difference. A lot of them also don't have a right or a wrong. Because people ask, what is the right setting? Well, there is no right setting because it depends on what you're indicating, what you trade, how you trade it, and what your strategy is. But I'll get back to that in a minute. The other part we get with moving averages is the question, okay, do you use a single, a double, or a triple, 5 moving averages? I mean, I've seen that one too, that's fun. Right? The question is, what are you trying to do? If I'm trading on 1 minute, which you shouldn't, but let's say you are, you're trading on 1 minute, right? You're trying to make really small scalp trades. Okay, do you use 5 moving averages? Well, yeah, you could, but you're going to have such a small range you can factor them into, because if you do your slow moving average, which is your longer period calculation, and your short moving average, which is a smaller time frame, so in sense of a minute, let's say, right? And let's say we put in the factor for the slow moving, the factor of 50 means the last 50 minutes, the last 50 candles. And the small moving average, let's go extreme, 1. Well, the 1 is going to fluctuate up and down like crazy, and the slow one is going to kind of like follow the curve. But because you're in such a small time frame, you're going to have buy, sell, buy, sell, buy, sell, buy, sell, buy, sell signal over and over and over and over. So if you now add a third one to that, which is somewhere in the medium range, you now have a second line that needs to confirm the buy or sell. So sometimes the short one will say sell or buy, but the long one doesn't yet, and the middle one doesn't yet. So you don't. Now that might sound weird, but I'm going to show you in a minute. So how do we set this up and how do we use it? Well, for that, we just simply go to a chart. So let's start with, I just grabbed the euro US dollar here because it actually looks pretty decent for it. So do you guys prefer me doing all of these in 4 hours, or do you prefer in 1 hour? It's the same to me. So just tell me what you prefer. 4, 1, 1, 1, 4, 1, 4, 4. Oh, come on, I should have made a poll. Right now, 1 is winning. Right, guess we're doing both because it's like a 50-50. All right, we'll just do both. It's fine. Don't worry about it. I got this. So let's just do this. All right, so normally when you do top-down technical analysis, you start at a week, you do your day analysis, and then you go to your 4 hours, and then you go to your 1 hour, right? Always top-down analysis. But that's for your trends, your resistances, and everything else. Your indicator, there is a setup for your moving average depending on your strategy. So let me give you an example of how you could set it up, and I'll use 3. For instance, we set up the indicator. Oh, come on, work with me. Moving average. It's a trend, we know that. The moving average. Now, some people ask me, okay, what about the adaptive one? What about the double? What about the triple? They all have specific uses depending on what you're trying to trade. Personally, I've never really used them, but if you really want to use one of those, then you have to first study exactly what it is that they do in order to understand what that work with your strategy. In general speaking, just a moving average is fine. You don't need double or triple exponential. Obviously, it's different layers of calculations of how the math works behind it. So you're going to get slightly different readings. And I mean slightly. They're not going to be massively different. Okay, keep that in mind. So like we mentioned, first of all, it depends what we want. Do we want a simple and exponential? Forget about smooth or linear weighted. Right, that is very, again, these are very specific scenarios where you would use that. So let's say simple, and the shift, forget about that as well. Shift is just, do you want to push the line backwards? And I'll show that visually in a minute. What is important, do you want to apply it to the closing price, the opening price of the candle after that, the high, the low, the high and low divided by 2, the high low close divided by 3, or high low close divided by 4. Again, the difference is absolutely minimal in most cases. The last one is much more stable. It factors in 4 different elements and then takes the median of that. The first one just takes the straight up close and divides it by whatever range. Now, most of you have heard of probably the 200. Moving average, generally speaking, is used between 15, 20, 30, 50, 100, and 200 period range. That's the average ones. So generally speaking, for the high, I just use 200. What does 200 mean? It goes back 200. 200, whatever time frame you're in. So 200 hours, 200 days, 200 weeks, 200 months. In this case, 800 hours, 200 times 4. Right? So let's plop that in. Well, that looks extremely high now, doesn't it? It does. But it is one part where we indicate. What do we do with this line? Well, the first thing that we want to do is it gives us an understanding when this candle touches that line, you might have a selling moment. You're going from bottom up. Coincidentally, if it breaks it, you have a selling moment. But here's a good example where it broke. Let me just plot that out. All right, so here, sell, sell, and here you would have gone wrong. Sell, and now we're on the bottom. Well, clearly this is not enough, right? It also works that way with buy, by the way, right? So it goes from the top, hits the line, you buy it. So basically it's kind of like, seeing here, buy. So here you would have thought, okay, maybe sell, and then maybe sell here, and then you would have gone win. It's not enough to just have the one thing. So let's throw in a second one. And you can use the same settings for 1 hour as 4 hours in this case. So whether you do it here or there, what you're doing is setting a frame. The only time when you really start changing it is if you go below 15 minutes. So 15 minutes and less, I would not go 200 period, because you're looking at a much more volatile market style. Right, so for 1 minute, I would use only 2 probably, something like 15 and 30. 15 is the fast one, 30 is the long one, right? Because you're only trading within, an hour time frame, maybe 10, 20 minutes is what you're trading. So what's our second one going to be? Well, the second one is generally speaking 50, which is your slow, your fast moving average on this 2 moving average line. Now we start getting a little bit more information. What information exactly? Well, here we have a crossover, which does indicate a buy, but it also shows that most likely it will cross over soon, which is what it did after. Right? It did become a buy, and then it did make the crossover. And here it crossed over again, confirming the switch. And it stayed all the way. And every time it got to this line, you have a possible selling moment again. It's not quite to the top yet, because that is your ultimate situation. And in some cases, it's not. I got a few people saying audio not working. Is audio still fine, guys? And girls, and everything in between. Okay, it's perfect. Okay, yeah, okay, so it's individual people, right? Okay, no worries. Right, so where was I? So this is the second one. So now we have a fast one and we have a slow one. So now you can already guess what we're doing next. We're gonna slot one in the middle. And then all we have, and understand I'm doing simple on all of them, and I apply it to the close. Now we have that slight little bit of extra information where we just have another layer of, hey, okay, so here it would have said, okay, potentially starting to sell, and you would have been right. You would have made profit, but here you break through, but it didn't, this spike stopped. It would have been here somewhere. And it started getting close, and you see here it almost touched. So you have an idea. It's like, hey, hold up. It's starting to lose momentum, because otherwise it would have pushed onwards after this candle. So probably it's going to sell again. And this is then also your exit strategy, right? When it starts to pull back, you close the trade or you enter in for the second one. Well, that is just based on your side. So this is based on your strategy, and this is just based on the moving averages. And you can understand already from just looking at what I did really briefly here is like it does give you an idea of when you can buy, because every time it gets to the long one, and if they just crossed like this, where you get the confirmation of crossing, okay, so let's say you're late for the party, you didn't go in for the sell here because you didn't learn how to do technicals. So you're at this crossing point, and then you have a second price action confirmation there, and then a third one you get here. So any of these moments you can take the sell. But alone on that is not enough. Because you can already understand, if you take it at the last moment, you've missed this whole party. Right? You missed this entire part if you go in here. So you only get to get the last 1/3 of the trade. With a potential, if you set a short stop loss for whatever reason, it pulls back and you hit your stop loss instead because you, I don't know, put your take profit somewhere over here. Right? So the moving average alone is not enough. So the periods that I used are, in this case, the long one is 200, the short one is 50, and the median is 100. Now the 100 is optional. You don't have to use it. I mean, that's a triple moving average. And obviously you can make it lower. So if you tend to trade on 1 hour, these will still apply perfectly fine. And I'm going to show you that because you still have the same idea. You're still factoring in the moving average on the close of the last 50, the last 100, and the last 200 candles. Except in a smaller time frame, you're going to more often see it hit the long-term one. Long-term, the higher the time frame you go, the less frequent it will hit it. The shorter time frame you go, now this doesn't make any sense at all. Because now my long is in the bottom, my short's on the top, and everything is flipped around. So if you would trade in a minute, you wouldn't trade with this. You would trade with, let's say, 15 and 20, which is going to be roughly the same. And then you throw your long one in, which is going to be 50. What is it? And that's your trading idea. So here you have a double cross. The long goes through the two shorts. So this is my confirmation to go in for a further buy. And you would have run the whole thing because it wouldn't have had a secondary cross. If we go in, did it cross? No, it just touched. I can't tell if that bends off to the bottom or not, but generally speaking, here it crosses, but it touches this one. So you take a buy, cross, sell, buy. But this is 1 minute. This would work up to 15 minutes probably, this setting, right? 15, 20, 50. But if I now go back to an hour, no. Right? This is way too sensitive for this time frame. We're getting way too much bending and twisting and turning and crossing. So our buying and selling signals we're getting are disproportional to the actual buying and selling moments that we have. So 1 hour and up, use 200, 150. Underneath that, you can use the smaller ones like 15 to 50. But keep in mind, anything in between works too. It depends on your strategy. What are you trying to trade and what fits in your strategy? How do you find out? Play with it. Check backwards at the chart. When would you normally trade based with it and without it? Right? So 50 is fine. Put that back to 100. And this back to 200. Now, for those that want to know what shift is, I'll do the middle one. If I say shift 10, all it does is shift it backwards forwards by 10. That's it. So you try to push it forward, you're extrapolating the data a little bit forward. So instead of being the late reaction because you're using historical data, you're now trying to predict it a little bit. Which, I wouldn't use it, to be honest. You really don't. You don't do that with moving average. There could be specific strategies where that does work, right? Breakout strategies, maybe, where you're trying to anticipate certain movements before they happen. But again, this is very specific to certain scenarios, right? So the end of the day, what is your strategy and your trading style, and what do you need it to tell you? But if you want a staple, just a standard one, 250, 200 being the slow and 50 being the fast, for 1 hour, 4 hours a day, fine. And you can throw in the 100 extra. So let's move on. The moving average on its own is not enough. We found that out. But what if we add a moving average based on convergence and divergence, also known as a MACD? Well, this one is an oscillator. It uses the same concept as moving averages. That's why you can combine them. They have the similar idea. Now, the way that it calculates a MACD is by taking a 12-period EMA and divide it by a 24-period EMA or a 26-period EMA. That will give you then a signal line that is an SMA, which is about half the value. Now, for those that just went, what kind of gobbledygook did you just say? Very simply said, you take two exponential moving averages, and you take the median of that, and then you compare it to a signal line, which is a simple moving average. So now you're combining in an oscillator exponential moving averages with simple moving averages. This is very commonly used in conjunction with the other ones. And what is the purpose? Well, the same idea as an average, right? To give you an idea of when things might be overbought or oversold, what kind of trend we have, either bullish or bearish, and a little bit momentum. So how would we set that up? Well, let's go to the next chart. We'll start in 4. We'll do it in 1 as well. It's, again, 4 and 1 are pretty much the same idea, right? So an oscillator, and we're going to use MACD. Now, as you can see here, the fast and the slow EMA. So now that you understand what an EMA is, it's a moving average. Right? 12, 24, 24 is actually wrong, should be 26. The original calculation is 12 over 26. You can adjust this any way you want, right? Again, it's, it depends on your strategy. Just play around with it, see what fits best. Generally speaking, your small moving average is going to be half of your fast moving average. So if I would do 24, then this one should be 50, and then this one should be 12. So let's throw that in now. So what does this show us? Well, the only thing that this really shows us is, as an oscillator, that whenever we get close to the baseline, we're going to see a flip. And in this case, we also know that when it starts reaching outside of its range, you're going to start making a move. So the second that these two cross, so that goes through your signal line, you should be buying. Now, if we put that into perspective, here it crossed and you would have bought and you would have made profit. Except it wasn't enough. It didn't continue onwards. Right? This whole period, it's kind of moving sideways, right? And then it bent off and we get a cross again. Here it crosses back into the territory. So here it moved out, here it moved in. So this is where it died, but this is also where your trade died. You basically just wasted a bunch of time. Now that could be because our periods may be a little bit funky. So let's go back to 12, 26, and 6. Let's see what it does. Oh, well, that makes more sense. Now we have actually an indication that this is where the buying moment started. Well, yeah, obviously. Now you can obviously say, yeah, but it goes sideways. But if you would, and I know this is hard, put your hand over the chart and forget about this whole part. If you would just be at this candle looking at this, you start moving outside of your range, you would know on the next candle in the first hour probably. Boop, where are we? Right here. So here, it would have told you to move into a buy here when the candle is still red. And you would have had a green candle and boom, you would have grabbed all of it. You coincidentally then also had, following that, an indication here where it moves out. Here it moves out of your range. So you could say, let's say here. Now you're outside of your range. It moves outside of that little block, that gray area, and selling that it's going to about to flip into a sell, and which it did, as we can clearly see the next candle's down. So this is your exit, entry, exit. Coincidentally, also entry for sell, which then also gets indicated as a exit point here when we go back in. And yes, again, it went back up after that. So you can already see that MACD is much better at than just moving average telling you when your entry and exit points are. So yeah, so the previous exits, yeah, so here's your entry, and this one is, and it's a good point. So if you would just do it simply like that, exit entry, exit here, or entry here, exit here. But you would take a sell, you would have lost that one. You go into the sell here, you get moving out. So it says now you have to buy again. You wouldn't do that, right? Because it's a little bit too flat. You can also guess from just how this curve is that it's just not enough momentum, right? You want curve, you want movement like that, like an S, right? So here we get to the baseline. We're out, we're going in, we're going in, we're going through. This is my buying entry again. So let's say you go buy in here, down draw, bomb into your buy. You stay inside of it the whole time. Here you exit, so this is your exit. Your exit is coincidentally also your entry for your sell, which is here then your exit point and entry for your buy. Right? You could literally do this all day and just flip them over and over. Where did it go out? So here it goes in, here it goes out. Now it would have been a very short trade and you would have actually missed most of it because it didn't actually flip till here. But you know, let's follow the rule, like you just blindly click on exit, you know, buy, sell based on this. Sell and take a buy. You close the buy and take a sell. Whoops. Got that line. No, can I get that line out? Oh, don't do this to me. There we go. So let's go out. We go back in. Now this was a sell that we close here. We turn it into, no, this was a buy. We close it into a sell. There we go. So here we sell again. We go down. We stay in. 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 We're still selling. All this time we're still sell. All right. So let's move. Move. We're still in. We're still in. Still selling, still selling, still selling, still selling. Ah, shit, stop loss. Right, in case you obviously weren't bright enough to go understand that, when you start seeing this happen in your trade, looking at the chart, not looking at this, yeah, it's starting to move sideways. You are at a low point. You have a double bottom here, so your resistance line would have started to pop up somewhere around here. The third time you get there, you probably would have closed the trade at that point, I assume. Well, let's say you didn't, then you hit this. All right, well, now you have a breakout. Okay. So you close your sell, or the sell closes itself, by the way, and you go into a buy, whichever point in this candle doesn't really matter. You go into a buy, and you have an exit point here because here it goes outside, so you take the sell. So let's say you go in here, you close there, you have this profit. It's not great, but okay, let's say that. Take a sell, you go back in, it decides to peak. Well, your stop loss should be above this anyway, based on this previous high. So your stop loss would be somewhere over here. You would have been fine. and your exit would be here when we go back in. So you close your sell and you open a buy. In this case, it wouldn't have worked out very well for you because this is where you close your buy, which is in a negative rate, unless it hit your stop loss, which in this case it probably would have. Right now, got another opportunity for a sell. Take the sell, go in. This is Friday. If you're a small account, you don't keep trades open in the Fridays. You just close everything at the end of the week. If it's in profit, no need to take a risk. But hey, now we get an indicator that we close our buy, we open our sell. We close our sell, we open our buy. Sorry. And you would have closed the buy here, taken a sell, hit a stop loss. Go out on your sell, take your buy again. So you starting to understand how this flipperino thing works. So close your buy about here, I guess. You close your buy, open your sell, and that puts us, well, over there. So we can keep doing this all day long, but I think you guys get the point. Right, so this is just based on an hour. You can go in and out and in and out and in and out and in and out. Now, if I do that on 4 hours, well, in 4 hours, we get a different picture. It doesn't say buy, sell, but that makes sense because we're going in a smaller time frame. Thus, we don't trade as often in volume and in quantity. We trade less often, but we trade for longer periods of time for higher profits per trade. Small time frame, short trades, short pips. Long time frame, slower trades, fewer trades, but bigger amounts. Makes sense, I guess, right? So this is the purpose of a MACD. It simply indicates you crossing points where the price could change. So recently we saw a buy because it started going outside of this and it goes into a buy. Wait, didn't we also see a buy here? Yeah, we did. It went outside of the range and is now correcting itself back in. If we take the same period, so let me go to 4 hours here. Let's cross-reference them. So this is at 1600. So let's do 1600 here as well. Just need to zoom in. 1600. Oh, that was March 3rd, wasn't it? So we would buy here. Your stop loss would be underneath this, so you would be in profit right now. Right, so this is just an assistance to help you find your entry and exit point. So I'm already doing two things. So I'm looking at this chart, I'm combining it with my moving average. Now I have two indicators confirming to me buy. All right. So that's the MACD. So again, moving average, and it calculates the convergence, the divergence of basically the trends, right? Or the exponential moving averages. I hope that made sense. I know it's a lot that we're discussing and it's difficult, and I'm not even scratching the surface on most of these things, but I hope it makes sense. So now we're going to have a little bit more fun because now we actually start getting to think of it. Now, I also want to know, what is the RSI telling me? So the relative strength index is a very commonly used tool. It was developed in 1978, so it's been around for a little while. It does not tell you the buying strength of something or selling strength. It shows you the relative strength compared to something. In this case, if you put two currency, it shows you the relative strength of one to the other based on its momentum. If you would do it in stock and you would compare two charts to each other, so two separate stocks, let's say GameStop and the SP 500. If you put them side to side with an RSI, the RSI will show the relative strength of GameStop versus the SP 500. It could be stronger or weaker. Right? That's what it does. We're comparing two currencies, generally speaking. So the purpose of it is to give us a little bit of an idea of its purchasing power or selling power, so its momentum and its relative strength compared to the other thing. So how much willingness is there in the market to buy or sell it? there's a way that we calculate that. Now, the way that the RSI works in the background, and we're going to get a little bit more technical here. You don't need to remember this. It's just in case you want to. The RSI works in 2 steps. The first step, it takes 100 minus 100 divided by the average gain divided by the average loss plus 1. Now, for most of you, that's going to be the what now? I know. Don't worry about it. The second part of the calculation is a little bit more funky. It's 100 minus 1 plus the previous average gain times 13, which is the average standard range, plus the current gain, divided by the previous average loss times 13 plus the current loss. And those two combined create your relative strength of the 2 elements together. Now, I don't know who's a math major. Who's a math major will look at this and go like, oh yeah, makes sense. For the rest, it's going to be like, sure, whatever you say, Mike. Just show me how it works. Well, let's do the second part. So again, a separate window for now. So let's throw it in there, right? It's an oscillator, so you're going to find it under oscillators. And we were looking for relative strength index, or commonly known as RSI. Period 12, well, like we said, 13. Now, averagely speaking, we use a weighted close. Like, remember, it's a 2-part calculation. It's high, low, constant, the close and close divided by 4. But we take a period of 13. Now, that's the default. You don't have to, but it works for me. This one also has a little bit of a different thing. So what does it show us? It tries to indicate to us in the relative strength when something is oversold or overbought. Now keep this in mind. I am actually going to change the period to 14, and it's going to become apparent why later. You can see that it twitched a very little bit. So this is why I said the difference between your settings is absolutely minute. So don't worry about it too much. What are these 2 levels? Well, first of all, I always like to throw in a third one. Oh, can you work with me here, you stupid thing? Oi. Thank you. We have levels. Now, I tend to actually put it to 20 and 80, and I will add a 50. And I think most of you already identified right away why. I just got my price action confirmation right here between these 2. It passed the 50 line, so this gives me the confidence to say, okay, it's probably a buy. Now, did it work out here, for instance? No. Did it work out here, for instance? No. And you go like, well, then this is shit. Fine. But what we do see is the following. What we didn't see here we see this, here we see this. Here we see this, and here we see this. So you wouldn't buy it. Now let's say I'm over here. Would you buy it? No, because you're passive. Would you buy it here? Yes, you would. But you would have already bought it based on this information over here. Okay, we're getting a bit close to time, so I can't really go into it right now. Q&A we can do. So let's go further. So you have diverging, converging, etc., etc. So here we have a nice little stable set that corresponds with basically this. That broke here. That doesn't show here yet, but it did show me here. And it came from a touch base oversold point. So if I didn't go in here, I have my confirmation to just go for it. This is turning into a buy. And here I have a secondary confirmation where it's now breaking through. And generally speaking, when it finally does, with exception here, with most of them, when it breaks, it keeps going, at least for a little bit. And here, this is a tricky one. And why is this one tricky? Because here you don't have a break. Look, if I would put this here, and I go through the 50, here it breaks it, I would have to literally go in here, but it's nowhere near oversold, nor is it anywhere moving up. It's literally just in limbo. Then this happened. So that could be a fundamental thing, right? So it could be a news announcement. Again, layers on layers on layers of decision making. Alone this was a false signal. Combined with everything else, the false signal gets clarified by other things that it wasn't a false signal, it wasn't a buy. There were some other factors that needed to be confirmed first. RSI is very simple. If that thing is below 20, it's probably selling. If you're going above 80, you're probably going to be buying. If you're on 80 and you're selling, all right, you're flipping, you're going down, you're going through the 50, then probably it's going to keep going for a bit. Especially if you're in a downtrend and you overbought, sold it, right? So overbought sell means that, let's say the RSI is over here, and it means that this one is over here somewhere. What is the chances of it going up versus down? Well, if it kept climbing straight up, it's probably going to go down. By the way, the setting is pretty much the same here in 1 hour. So here's the fun thing. You go through 50 here, showing that it wants to go further. And 4 hours, it has plenty of space. On 1 hour, it doesn't. On 1 hour, we're getting to overbought levels, which probably means, because here in 1 hour, we saw that the buy was actually here, not here. So here was actually the buying moment based on 1 hour. Short-term time frame. All right, we crossed it. Here, you can see why you don't have any clear signal. You're just like bouncing around. You have a clear signal to buy here. Buy it. Buy it. Right, you get a swing. Buy. Let's say you wait for this. You can still buy. Let's say you wait for this. You can still buy. We cross through. Okay, buy it. You cross back through down. Well, guess what? You could close the trade. That's your exit point indication. You buy it again, and we're still running. It's probably going to bend off, go back down. It's probably going to do something like, now you might be thinking, why is he drawing trend lines on an oscillator? Yes, you can actually do that. There's reasons for that. We're talking about moving averages, so there is trends and resistances in them as well. Right, and here we have, whoops, the same line. All right, now if I do an equidistant channel on top of that, oh, we have a slight acceleration. Well, look at that. Well, that explains where the acceleration came from. It went out, it hit the trend line, accelerated. So what would you do here? Well, we know now, based on this, that it's actually getting to the peak, which means that probably it might spike, but probably it's going to pull back down and then back up. And that is what the 4 hour tells us. It wants to go further up, but it's probably going to pull down and then back up. Right? I know for some people are just staring at the screen now and going like, I have no idea what the hell he just did. Back to the basics. If below 20, buy, below above 80, sell. Confirm with own eyes on price. I can't make it simpler than that. The more you do the analysis, the more cross references, the more technical analysis you do on top of that, the least amount of false signals are going to catch you off guard. But if you would blindly buy and sell every time it does 20 and 80, you'd probably still have a profitable trading account, unless you trade with completely wrong risk management. That's a topic that I discussed before. Right, so we're starting to make a little bit of head straight. Oh, we got 10 minutes left, 2 to go. Might shoot over a little bit. So the next one is another oscillator. It's called the stochastic. Most of you are going to be familiar with the stochastic. So what it does is it measures the closing price in comparison to its average given price range. That's it. So it's a momentum kind of thing. right? It gives us overbought, oversold information based on momentum. That's it. So what does that show? Well, this is how it works. The percentage of K is 100 between the close minus the loss of N divided by the high of N minus the low of N. Not loss, low, high and low. N is the range. Now, by default, the range is 14. That means 14 minutes, 14 15-minute periods, 14 hours, 14 days, 14 weeks, or 14 months. These indicators take over. But again, if you're trading in a small time frame, you need indicators to be more flexible. In a longer period of time, you need indicators to be less flexible. Now, stochastic is one of those weird ones where you kind of use 14 everywhere. Because again, it gives you momentum idea. It doesn't show you anything else. I would actually argue in lower time frame, you would set stochastic to be a bigger range. Because otherwise it just flips up, down, up, down, up, down like crazy. I'll show that. But there's two parts to this whole thing. That's the second line. And that one is percentage D, which is a 3-period moving average based on percentage K. Don't worry about that means. You don't need to understand how any of that works. But just understand it calculates from two parts. So how do we set it up and how do we use it? Well, let's go back to the chart. That's Bollinger. Can we just get rid of this? No, just delete the damn thing. We'll get back to you in a minute, John. Right. So what we're doing? Yeah. Where is it? Stochastic. There we go. So I don't need to slow down. Now the slowing down is the period. So this is the percent D. So you can make it 4. You can make it 2. The default is 2, right? But the percentage period 3, 14, slowed 0. This is the default that it should be. 14, 3D, 0. Now you can do it based on the closing prices, or you can do it on low high. Leave it low high and make it, leave it at linear weighted. The reason it's linear weighted is because it's weighing the 3 averages. Right now, maybe this makes then sense why you use linear weighted is because it's using the 3 EMAs that are based inside of it. I hope that makes sense. Right? We all know these levels, 90, 10, 50, stays the same, whatever. Scale, any of this doesn't really matter. You can play around with it, you don't really need it. So what does this show us? That's a bit too much. Well, every time it gets to the top and it crosses through the small line, it says we should sell. So let's see if our settings are right for 1 hour. Let's do 1 hour. It says here we should start selling. Well, I'll be damned. Wait, wasn't that what the MACD told us as well? Wasn't that what the 1 hour MACD told us as well? Wasn't that what the 1 hour moving average told us as well? Wait, hold on. Oh yeah, it did. Okay, wait, hold on. What about this one? Oh yeah, we went in. So it was a buy, but it's probably going to turn back down. So this is still a hold. This is, yeah, we knew that it's probably going to bend off a little bit because that's what this one says. We're almost overbought on the hourly. Well, I'll be darned. This one is confirming that as well. Now you might think, okay, this is a little bit too close to each other. So let's make the period a little bit higher. Let's go 5. That shifts the line under. So the bigger you make the period, the more averages you factor into the equation. Right? They default set it, I think, nowadays to 13.7, I think it was, and slow by 2. So something like this. I mean, it's not wrong, but I personally just prefer 14.5 and leave it at 2. Because look, this one now tells me to sell, where the original, the 13.7 setting is telling me not to sell yet. It's not confirmed yet. And I'm the kind of guy that just goes in first because I don't want to wait half the trade and then go in for price action confirmation. I'll take the risk here because if I get it right, I have the maximum run, which risk reward ratio wise means that my stop loss is much tighter than yours, because if you go in here, your stop loss is going to be here. I go in here, my stop loss is here. I risk way less pips, so my lot size is much higher. Right? Let's say we both do 5% of our capital and we both have $2,000. This stop loss, 5%, is a much higher lot size. Here is a much smaller lot size, which means that my profit point, somewhere over here, right, based on this horizontal line probably. So I would go out here. This is my exit point. So my stop loss would be something, my entry point here, my stop loss would be somewhere, well, what's the previous high? This. And then you have this one. What's this, an hour? Okay. So we actually had a high point. So yeah, I would probably put it above this. So let's say my stop loss is over here, and my exit point would be somewhere along this line, right? So my stop loss is 17 pips, and I take profit of 40. But if you wait for price action with the other one, it's going to show somewhere around here. Your stop loss and your thing are going to be the same. So you're risking 30 to make 30. So you're already one-on-one. But if I take 5%, my risk is 5%, my profit is 40 versus 20. So I am gaining twice as much on a higher lot size as you waiting for a price action to be a little bit delayed, which is what would happen if you go for the 14, what is it? The, what did I say? Yeah, I want 14.5 because it confirms me now to go in. Which is, we know that it can fluctuate up and down a little bit because it's not quite there yet, but the chances that it's going to turn is pretty damn high at this point. So we're going to cover one more, and I'm just going to slap it in here. Bloop. Hold your horses. Right, so stochastic is really simple. There's not much to tell. Overbought, oversold, momentum. When the solid line crosses the dotted line, you buy or sell, especially when they're both, right? The idea is when K and D are both above or below a certain line, K being the fixed one, D being the dotted one, when they are both above 90, sell. Both below 20, buy. You don't even have to wait for them to cross. That's just kind of the idea behind it. So when they cross, you just have a double confirmation, period. So let's go Bollinger Bands. So Bollinger Bands, I just said we're going to get back to John. Developed by John Bollinger, who was a famous technical analyst. Basically what it does, it sets up two trend lines, and it's an overlay, so it's going to go on top. Right, so this basically plots a positive and a negative around a moving average, which gives you a range, right, away from an SMA. So the middle one is a simple moving average, and it gives you a positive and a negative, basically two ranges, right, a band. Now this expands and comes together. There's a reason for it, because what it does, it's on a technical basis in the chart as an overlay, shows a little bit better the idea of overbought and oversold. Now, generally speaking, if you have a prolonged period of time where the three lines are close to each other, which is called a pinch, usually a pinch is a time of inactivity, which usually gets followed by a time of volatility. So it's going to like burst open at some point, break out. It doesn't tell you which way though. That it doesn't do. But it does show you like, okay, there's a long period of time where it's stopped. There's no volatility. And the other way around, if you have a long period of volatility where there's a lot of range, it's going to eventually slap together and get a long period of time of no volatility. And this is the oversold, overbought idea. So let's just set that up real fast. So if we would indicate, if we grab John here, where are you, buddy? Our dear friend John. Bollinger Bands, there you go. So standard period is 20, by the way. And you can just leave that as is. The settings are correct. You don't really have to mess with this thing all too much. Right? We know high, low divided by 2. That's the median price. Simple moving average. You can do it on close, but just leave it on the median price. And it gives us this. So what does this tell us? No, the same thing we just saw in the thing. We're overbought. It's outside of the Bollinger range, so most likely this will sell. Did it do it here? Yes. Did it do it here? Yes. Right? So buy, sell, buy, sell. Over the Bollinger, so it turns into a sell? Yes. Does it touch the bottom? Does it turn into a buy? Yes, but then immediately goes back down from the average. Right? This is one of those periods where, well, you're in a sell here, so you wouldn't be in, out, but if we go to 4 hours, it's a little bit less jumpy, but yeah, you would have, you're outside of the range here. So we're going to get a selling moment. When do we get that selling moment is the question, because on its own, it's not enough. But you can wait for price action confirmation. So here you could go in, your stop loss in this case would be above the nearest resistance, right? So you would have been fine if you went in right there on this candle. Down draw, boom, back to 0. And then when you touch the bottom, exit, signal to go out because you're at the bottom range. So you're oversold now. You close your sell, you open your buy, you go back up. Hey, you close your sell, etc., etc. So all of these individually, great. They give us an idea, but they also have a lot of false signals in there, right? Like, it's selling. I should buy here. And it just keeps going, and it keeps going, and it keeps going. And then, no, just sideways. And it keeps going. And now it decides to turn. All indicators have one common problem. They are based on historical data, ergo they're not predictive, they're reactive. They give you an idea of a range based on how it's built up, based on momentum, but it's not enough. So what happens when we do this? Now most of you are gonna go like, oh Christ almighty. This is all of the 5 that we discussed. So imagine what happens if I tell you I've had people come to me and they have 8 set up. This is just 5. Imagine having double this. Individually, they all tell you something. Combined, they give you a good indication. Based together with technical analysis, forget about the entry point ones because we already did that. Where did I set them up? Here. Okay, I just wanted to do one. This was just a perfect moment today because this was all a perfect alignment. Buy, buy, buy. Everybody was saying buy. And your technical analysis would have shown, okay, this is sort of a potential bottom trend. In the 4 hours, we also have an arrow. Now, if I go to a day, I actually put an arrow in because we have here the full range here. We now have a crossing of the slow and the fast. So probably it's going to pull back up. So most likely, what's more likely for the euro US dollar to happen, it's oversold, it's moving out, and they just crossed. What is it going to do? Well, if you put a gun to my head and tell me to pick a direction, I buy. That is the most likely scenario of what is going to happen next. The only trend that we haven't drawn is this one. But this one is most likely going to break because it's a little bit of a triangle that is starting to happen here. It's not exactly perfect, but something like this. So this one was broken and then broke back out. That was probably a test. So let's do this. Now, if you combine this together with resistance, price, and stuff like that, you're going to get an idea of, well, we're at the 770 mark. There's probably a lot of sellers that are going to start considering closing. At the very latest, they're going to start closing here, which is the previous low. So there's probably a lot of pending buy orders here when you get to this price, 116,200 probably, or 116,300, because people like even numbers. So there's going to be a lot of buying orders here. So if this starts moving down again and you get to 11300, yeah, you can bet your ass on it that it's going to flip into a buy. Because everybody's going to close their trades and there's going to be buys opposite. And because people close their trades and buys are going to be taken, the volume flips. So in a 4 hour, which is a more shorter time frame to look at, we have enough information to know that it's a buy, goes back, buy again. And probably this is going to start accelerating. It's going to pull back a little bit, dead, pull back a little bit, what this says, but it's going to start gaining momentum based on the MACD. And this only just crossed, so probably it's going to pull back and cross over again. This is probably going to go back to 50 and then back up. This is probably going to go back to 30 and then back up. So this is probably going to make a swing like that and then back up. So long term, yeah, you would take a buy. Now that, my friends, is all of the 5 combined. In that sense, I would like to thank everybody for watching thus far. I hope it was as confusing as it was entertaining, but hopefully everybody learned something.